Latin American financial markets rose on Tuesday after US Federal Reserve Chair Janet Yellen brought relief to investors who feared she could hint at a June interest rate hike. With me down the line to discuss is Aaron Pinnock. Aaron, looking at Brazil, analysts say above all it is the economy where the storm clouds are stacked highest. China's slowdown, combined with the end of the commodities supercycle, means falling prices for Brazilian exports of soybeans, iron ore and most recently oil. But is it all doom and gloom at present?
For Brazilian exporters, we don't think the situation is all gloom. So the big depreciation in the real over the last several months has kept prices high for many of the primary exporters. Looking at agricultural commodities specifically, the price of sugar, for example, remains pretty high in real terms, despite a pretty big decline in US dollar terms over the past 9 months. So the profitability situation in the sugar sector, for example, is starting to get a little bit better. The exports of other commodities, such as soybean, are a little bit slow. So increasing inflationary pressure and expectations of a further currency weakness from farmers means that these farmers are holding back produce as soybean value could rise in the future. So we've seen this happen for several years in Argentina, the case of soybean hoarding, and worrying it's translating into Brazil. The current truckers' strike in the country isn't helping as well, of course.
We had data this week highlighting the country's current account deficit widened. Inflation is also a problem. However, new agriculture and trade ministers with ties to farmers and industry signal a truce with the maligned private sector. Could this be a silver lining? What benefits could this bring to the situation?
So I think the main fact that the real continues its sustained weakness despite the widening current account deficit demonstrates just what a poor situation Brazil currently faces. So Rousseff has definitely tried to please investors with more market-friendly measures and certain appointments in their cabinet. But generally speaking, these have been to little avail. So we as a research institution remain bearish on the real over a multi-quarter period. Recent tax hikes have soured investor sentiment, and a standoffish central bank has allowed the currency to fall further than many had anticipated. Regarding the agricultural sector, we hold a pretty similar downbeat mood. But as you said, there are definitely silver linings. I'll bring up the sugar and ethanol industry, for example. This sector, in our opinion, is going to face a much better 2015 than 2013 or 14, given currency dynamics, which, as I said, have made the price of sugar better in real terms, and the decision to raise the blending mandate for ethanol in the country has certainly improved that side of the sector.
Also supporting the Brazilian real was a report the Brazilian government is working on a plan to save up to around 80 billion real to meet this year's fiscal goal. However, investors remain wary. But what are the main challenges affecting Brazil's economy moving forward, and to your mind, can they be overcome?
So as I highlighted before, our Brazil team here holds a pretty negative outlook regarding the economy. Despite the real sell-off, the country faces a lack of export competitiveness. This is on the back of high electricity costs, high labour costs, and red tape issues, which have been an issue for a while. So we see a widening current account deficit over 2015 compared to last year. Lower oil prices will be a boost for the current account, but they won't flip the trade account back into the black. We see the deficit widening from about 4.1% of GDP in 2015 to 4.5% this year. This will place further downward pressure on the currency. In terms of GDP growth, we forecast about 0.6% in 2015, which will be a slight increase on last year at 0.2%. And GDP growth will mainly be constrained by tepid private consumption and fixed investment. This will dampen investment inflows, which would be the main factor weighing on economic growth. High inflation, which continues to be a problem in the country, will mean that the Selic rate will remain high, and we see it ending the year around 13%, which will further, as I say, weigh on private consumption and fixed investment. So we see a difficult year for 2015, but improving as the year carries on.
Aaron, great to speak with you. Thank you for your time. Well, viewers, later today, Yellen will be back on Capitol Hill, so stick with Dukascopy to find out how round 2 might affect your trades. Goodbye for now.